All right, welcome to the July 2023 monthly MOTR checkup. My name is Dave Lundgren, and I am the Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. First, I want to welcome to MOTR Research all of our new clients from the past month. We've had a super busy month, and we're sure happy to have you on board with us, and I hope you enjoy your first monthly MOTR checkup. The name of this video is There Must Be Another Economic Boom on Earth. Which I'll explain, but in jest, it basically means that if you were an alien and you just landed on this planet and all you knew was the leadership of the market, you'd have to conclude that there must be an economic boom going on Earth. Before we get into that, let's take a quick look at your favorite part here, the important disclosures. Okay, there must be another economic boom on Earth. So an alien visiting Earth, knowing only current market leadership, would have no choice but to conclude that we're experiencing an economic boom. Things are just too cyclical. If you would just simply say, what is your wish list in terms of leadership? If you were to have a bullish outlook, and you'd be pretty hard pressed to find anything better than what we're finding today. So if this is what you like to see in a bull market and you're resisting the fact that we're in a bull market, that's going to be the disconnect you're going to have to wrestle with, because everything we're seeing suggests that the market likes what it sees when it looks out into the future, because the leadership sure does look like it's rather cyclical, growth oriented, and just getting better as the time goes on. Also, if the bears could wish for any catalyst to force their narrative to play out, one must imagine that a banking crisis would surely top that list. And of course, we got a banking crisis and nothing happened. So I think we can't ignore that outcome. I mean, the idea that we had 3 of the 4 largest bank failures in the last few months in U.S. history happened in the last few months, and yet the market didn't break down. I just think that's something we can't ignore. I think we have to really contemplate what that means. And it suggests to me that the market is really, really more focused on what's happening in the future. And one could argue that all of the bear market activity that happened in 2022 was actually the market telling us about these impending bankruptcies and the implosion of crypto and the FTX and everything else. And that's likely why the whole market bottomed when the whole digital asset implosion came to a crescendo. And when we all finally understood why the 2022 bear market was happening, and we could finally understand it, and the headlines were supporting what we were finally learning about, the market chose to bottom then. And so the idea is, and I've talked about this a lot, I've written about it, I've featured many charts to demonstrate this in the weekly MOTR reports and in the charting my interruptions and whatnot. But this is just the nature of the markets. This is how it works. We don't understand why it's going down. And then when we finally do understand why it's going down, it goes the other way and continues to go higher even as things get worse. So to that point, after the Silicon Valley earthquake and a couple of more aftershocks, market internals are once again getting better. So we continue to believe that the message of the market is that it likes what it sees into the year end 2023 and beyond. So the risk gauges continue to edge closer to risk on at the market level. And, when you look at the daily, weekly, and monthly timeframes, we see daily is already on into risk on, and the weekly and monthly timeframes are just one notch below that. Now, keep in mind that the weekly and monthly, this is Wednesday as I'm recording this, weekly and monthly signals won't be locked in until the end of those 2 time periods, so end of the week and end of the month. But directionally beneath the surface, we can see that things are getting better and better. The quarterly time frame is still at 6, but we know during the past month it upticked from 7. And this is inflecting in the right direction. Keep in mind that this quarterly time frame, this is the time frame that's driven by fundamentals. The direction of this signal is what matters more than the actual level itself. And the positive inflection that we're seeing here is just indicative, more broadly speaking, of the market improving across the 5 inputs that go into this risk gauge, which once again are price trend, relative price trend, cross-sectional momentum, volatility, and breadth. Those are the only things that go into this model. And across these 4 timeframes, that we're just continuing to see improvement day in and day out, week in and week out. And that ultimately is what matters most. When you look at leadership, it's still industrials, tech, discretionary materials, and that remains very steady. What we're finding is that as time goes on, more and more of the time frames in the leadership is hopping into that risk on category. And again, the primary point is that the risk gauges for the market itself can't possibly get into risk on. Remember, these concepts, these trend following concepts, are all what we call fractal, meaning that the quarterly can't get better unless the monthly gets better first. The monthly can't get better unless the weekly gets better, and on down the line down to the daily. So that's a fractal nature. Quarterly can't get better until daily gets better first. We're seeing that that's happening here. It's also true that the market's risk gauges themselves cannot possibly get into the risk on category unless leadership does that first. Leadership has to get there first, pulling the broader market with it. And so when we understand that to be the case, we can't be anything but encouraged to see that more and more leadership is making its way into this risk on across multiple timeframes. So once again, that's a very positive development at the margin. Not just positive, but necessary, and it's happening. Energy is not in the top 5 yet, but it's closing in fast. As you can see here, it's now at 8. Recall not too long ago, it was down there in the bottom, which was no easy feat because it's quite a knife fight to get down there. It's been so bad. Staples and utilities are nowhere to be found amongst leadership. If you recall, throughout the course of 2022, that was one of the problems. Staples and utilities were consistently in the top 1, 2, and 3 spots for leadership. Just once again confirming that we did not have the leadership necessary for a bull market. That's clearly been turned on its head here. Now, it's absolutely true that we are overbought. And one of the things I've added to the risk gauges for your viewing pleasure, if you will, is each of the time frames relationships to its moving average. So in the short term, we can see that 81% of the market of the stocks in the MOTR universe, which is about 2,500 stocks, 81% of them are above their short-term moving average. That's a 15-day moving average in this case. 77% are above their 50-day average, and 64% are above the 200-day average. And then lastly, 65% of the 200-day moving averages are actually rising. So the point is that as we're just starting to get into risk on, just tells you how early we are in this move. And in fact, another way to indicate that we're very early is that none of the long-term risk gauges are in risk on. So this will be a robust, full-on bull market when the risk gauges start to get on into risk on in these long-term gauges, but we're not even there yet. Just once again, underscoring how early we are in this move. And the whole point is that if we're just starting to break out across these timeframes, you have to be overbought. There's no way you can possibly break out without being overbought. And in fact, the more overbought, the better. So yes, we recognize that it's overbought. Yes, it's possible that this overbought condition could result in some near-term weakness. The point being, though, that because we're so early in this breakout, in this trend inflection to the upside, whatever weakness we do see should be rather narrow, should be rather shallow, I should say. So keep that in mind. It's not that oversold conditions can't happen. It's just that whatever does happen should be relatively muted and not an awful lot of downside progress being made during these oversold conditions. Here's another way to look at the market, just looking at ETFs. So of course we follow 2,500 stocks. We also follow about 500 ETFs, and this is a trend model that we talk about all the time in particular in our the weekly MOTR chart packs. And what we're doing is we're just breaking trend into uptrends and downtrends, and then labeling each depending on where each of the stocks are within the context of that trend. So uptrend 1 is a stock that's in an uptrend that it's broken out recently, so it's now in a new uptrend, but it's kind of waffling a little bit and maybe pulling back below the point of breakout, which is fine. It's actually a rather timely entry point. Uptrend 2 is an uptrend that broke out recently, but it's less than 8% from the breakout. And then as you move down, it just gets more and more extended. So all of these are good. It's just that they're less timely as you move down this list of from uptrend 1 to uptrend 4. And then of course, up base 1 and up base 2 are uptrends. They've just gone into a base. And again, so they're constructive, they're good structure. It's just that they're not trending in this moment. So again, just trying to bucket the market according to these these different trend conditions, and then the downtrends are the same, just in the opposite. So a downtrend 4 is a stock that's in a downtrend, and it's just really extended. It's more than 15% down from the point of where it broke to the downside. What's most important here that I really want to highlight is this category here. So what we're just doing is we're just showing of the 2,500 stocks that are of the roughly 500 ETFs that are in the universe that we monitor. 194 of them are in down base 1, which is a downtrend that's gone into consolidation. It's recovering, and it's a possible bottom. This once again shows you how early we are in this long-term trend change. Most of the ETFs are in this basing structure of a downtrend. In the way we're identifying is that it's a possible bottom. When you step into the next timeframes down, what we find is that the biggest buckets are uptrends that have recently broken out and are less than 8% away from that point of breakout. So once again, big bases on the long-term chart, trending in the short term and the medium term, and not extended yet. So this is what it looks like when you look at roughly 500 ETFs across the U.S. and around the world as well. And what we find is that we just see a lot of basing structure that's really kind of just getting started. So we find this to be quite constructive as well. I think this is a really important point to make as we move forward. Prior to the banking crisis, we saw a lot of evidence to suggest that we had seen enough evidence to indicate that the market had bottomed, and we should now begin a basing process. The first hallmark of that basing process was the momentum crash, which happened in October, and then again more meaningfully in January. We talked about it quite a bit as a very important point of evidence to suggest that the market was bottoming. Off the bottom, what we found was that going into the lows, as the mid-cap index was going lower with everything else, large caps, NASDAQ, all of the digital assets and commodities and everything else that were heading south into 2022, into the bottom in October, as the mid-cap index was participating into that bear market bottom, we began to notice that the relative performance was not participating. So we're beginning to see this relative performance divergence from an area of the market that should be participating on the downside more fully, much like it did through the COVID crash you see over here. So this is the market's way of telling you during a bear market what the next bull market will look like from a leadership perspective. Whatever offers uncharacteristically strong leadership during a bear market is the market's way of telling you that that's going to be future leadership when the next bull market starts. And of course, we can see that when the market bottomed, the mid-cap index definitely began to show an awful lot of strength. So we began to believe, we were of the mind that not only had the market bottomed, but that the mid-cap index would be the leadership. And we also and as a point of evidence in that regard, we saw that the mid-cap index actually broke through its August bear market peak before the rest of the market did. Once again, this is how leadership makes its way to the forefront, by breaking out first, by diverging off the bottom. We saw an awful lot of that from the mid-cap index. So at this point, prior to the banking crisis, we believed that the market had bottomed. We were positioned accordingly. We had already covered all our shorts, and we were focusing our portfolio on mid-cap ideas. And then, of course, with the idea that this would be leadership, and of course the banking crisis hit. Now, what's most important about this is that as you know, the mid-cap index and the small cap index, they both have a lot of banks in them, despite the fact that they were so weighed down by banks, which were basically plunged because of the crisis, as you all well know. Despite the fact that they were so burdened by banks, they did not break support. And I just think that again is something you just can't ignore. The very fact that you had a banking crisis that consisted of 3 of the 4 largest bank failures in U.S. history, and we weren't even able to take out support, is really important. So on a price level, we held support, and also from a relative relative performance perspective, we also held support. I just think you can't ignore that. I think that's really important. The bears had all the ammunition they needed to take the market lower in that moment, and they didn't. So I think what's happening now with the mid cap index now taking over and getting through the August peak once again, it looks to me like that message from early on off the October bottom, which we believe was always when you inflect trend in a meaningful long-term primary time frame like the quarterly trend time frame, the 200-day average turning higher. That's the market's way of identifying the best fundamental conditions in the market. When that happens, we believe that it's happening for fundamental reasons. From time to time, that fundamental thesis can get tested. Clearly, that banking crisis was a major test, and we would say that the mid-cap index survived that test and is now just once again positioning to take over leadership once again. Now, obviously, a relationship that's been really a seesaw between mega caps and mid caps has been this motor management index, which we've been highlighting quite a bit. We've referred to it as the motor management index, which is basically those 9 stocks that have been driving the market higher. It's just an acronym index for those names, but I've also referred to them as toothpaste tech. And I refer to them as such because of their recurring revenue stream nature. Basically, portfolio managers flock to Microsoft today like they used to flock to Procter & Gamble because of their recurring revenue stream. So in many ways, you can say that this big rally that the management index had off the January bottom was both a consequence of the AI craze that went on and is still going on, because obviously there's a lot of fundamental trends that benefit these companies, and so therefore they went up an awful lot. But I also believe that a large part of this rally had to do with the fact that these were toothpaste tech recurring revenue streams, and portfolio managers flocked to them because of their safety. Now, as we look at what's happening since the mid-cap index has started to resume leadership once again, the motor management index looks fine. It's still trending. That there appears to be no issues here with the price trend, but the average stock has begun to stabilize once again, and it's now starting to hit local highs again, as it was prior to the banking crisis. And it's doing its rate of ascent is now picking up at a rate that's faster than the motor management index, resulting in the relative performance of these toothpaste tech companies beginning to falter. And as a consequence of that, it's actually beginning to test the relative performance uptrend that's been in existence since the beginning of the year. Now, if the motor management index begins to falter from a relative performance perspective, that's not bearish at all. In fact, it's actually bullish. It actually resolves this big disconnect that we've been talking about for several months now, about this big breadth divergence where you have a big part of the market. By that I mean market cap part of the market moving higher with the rest of the market not participating. Not everybody, but most people were insistent that was bearish. We were of the view that it wasn't necessarily bearish, and it was more that this is just how bull markets begin. Leadership takes off first. It's AI driven. Yes, as I said earlier, it had also to do with these mega cap companies. It just so happens that the leadership in the beginning was also partly mega cap, so that had the influence of making this large divergence rather evident between leadership at the time and the rest of the market. And the big difference between this divergence, which I've highlighted in the past, is that this divergence is happening at the beginning of a bull market, not at the end of a bear market, which is when most divergences of this magnitude actually matter. So our take on this was that it would ultimately resolve bullishly one way or another, and we are finally beginning to see signs of that as the participation in this bull market begins to broaden out. So speaking of broadening out, energy is the latest beneficiary of this trend. So after reversing a major relative performance downtrend in 2020 and into 2021, the energy sector, of course, ripped higher in 2022, despite the fact that the market was itself going into the throes of a bear market. The relative performance target was quickly met. And then from there, the energy sector relative to the market has just basically gone into a sideways range. Now, the main point to identify here is that during this range, the sector has not broken any kind of supports developed during the uptrend that developed after the big base breakout. So this leaves the sector in a position to still take over leadership. And I think the reason that we need to be aware of this is because this big base breakout here actually reversed a multiple, I think it was about an 8 or 9 year relative performance downtrend. So this was a major relative performance reversal, and the pause, the 1 year relative performance pause that has taken place since then has done nothing to threaten that uptrend in relative performance. So really, we're just looking for evidence that the trend is beginning to resume again, and we are beginning to see that in spades. As we look at it right now, the sector, the energy sector, is the fourth best ranked in terms of trend. So when we look at what we can rank all of the sectors in terms of what percentage of the sector ranks above 50 in terms of the trend rank, and we can see that the energy sector is the fourth best, with 63% of the sector ranking above 50 according to our MOTR trend rank. So it's, from a trend perspective, is very strong. Because it's done so poorly, quote unquote, or at least certainly not particularly well over the past year, the relative the momentum ranks, only 38% of the energy sector has a momentum rank above 50. So this is how it works. This is why we as portfolio managers use both price trend and relative performance to make decisions, because price trend inflects quicker in more proactively than does momentum. Momentum tends to follow the price inflections. So what we're seeing here is that we're seeing a significant price inflection in the trend of energy. We highlighted it last week in the weekly MOTR report, where we showed that the majority of the price breakouts, most of outside of industrials, the sector with the most representation on that list of price breakouts over the past month was actually energy. And again, that's really constructive. That's a broadening out of leadership. And the fact that the momentum score is not there yet is fine. We believe that in time, this relative performance trend will resume again, and will pull this relative performance rank higher in time. So we're beginning to build exposure here in the energy space. We'll continue to highlight new names in the weekly MOTR reports, and subscribers to the sector spotlights should look for an energy sector review in the days ahead as well. So of course, crude oil will play a key role in whether this plays out in favor of the energy sector, as you can imagine. We're seeing signs that the price of crude oil is finally beginning to stabilize, with a rounding bottom here, really beginning to lose a lot of momentum off the bottom. So we're beginning to see a bullish divergence where price went to new lows, but the momentum, as measured by this MACD moving average convergence divergence indicator, has not hit new lows. So we're beginning to see this bullish divergence off the bottom. This is important, because if oil begins to turn, this is a key, as you can imagine, a key driver to relative performance for the energy sector. So this gold line is the relative performance of energy versus the market. And we can see that these two things move together. So if oil begins to turn higher, which is what our suspicion is, then we'll begin to see the energy relative performance turn higher with it as well. We're not going to have full confirmation that oil has turned higher until we get above this 80 to 85 resistance area. But it is our belief that that is what's impending, simply because we're beginning to see so many breakouts within the energy sector, as if the market's looking forward to the eventual break through the 80 to 85 level by crude oil. So the energy sector is already behaving in a manner to suggest that the market believes that this is what's coming. One last chart before I get into some levels to watch for the S&P 500. This is just a bit of a macro chart. No real conclusions here, but I think it's interesting to note with respect to inflation expectations. So what we're looking at here is back to 1997, just the spread between the tips and the nominal treasury, and the line shooting across the middle. This is the average inflation expectation over the past since 1997, and then plus and minus 1 and 2 standard deviations. So kudos to the Fed, of course, for keeping inflation expectations very much anchored to their 2% target. It's literally the average has been 2%. That's that yellow line shooting across the chart. So kudos to the Fed for a job well done. With inflation finally coming off the boil now, we see that the inflation expectations right now are right around 2.25%, which is right in the middle of the Fed's 2% average target, and the plus one standard deviation from that target, which is roughly 2.5%. So inflation expectations are now roughly right in the middle of that range, and one would think that this would be good for the stock market. And oddly enough, when you actually look at performance forward returns of the market, whenever the inflation expectations are somewhere between the 2% target and one standard deviation above, it turns out that the returns are positive, but they're just well below average. So hence, careful what you wish for. So what we can see here is that returns in the forward returns for the market are actually higher when the expectations of inflation are well away from the Fed's target. And so given that we are now sort of sitting right in that sweet spot, this is where the majority of the time we are, where the inflation expectations are. It turns out that at least from this standpoint, it's would be reasonable to expect below average returns. So this is something to think about. We're not acting on this, of course. And again, this is a good opportunity to highlight that things like this is why observations like this are not in the risk gauge, because this may or may not matter. Much like sentiment didn't matter last year, where everybody was really bullish. Everybody was really bearish last year. You would expect, if everything was normal, that the market would bottom, because when everybody gets really bearish, that's when the market bottoms. The reason sentiment is not part of the risk gauges is because it doesn't have to be that case. It doesn't have to be that way. So all the things that are in the risk gauges are things that are what I refer to as inviolable. They must be true. And so this doesn't necessarily have to happen this time going forward, but it's just something to think about. Keeping the back burner as we're monitoring inflation expectations, and maybe the conclusion might be that if inflation expectations begin to turn higher, maybe that won't be such a bad thing. Okay, so as we move forward, some levels to keep an eye on as the market begins to move back and forth in its ranges here. So although the conditions are aligning bullishly, this does not at all mean that we won't see market weakness. In fact, we want to see market weakness because that indeed is what makes for a more bullish and healthy overall market condition as it shakes out those the weak hands, if you will. So the key is to anticipate the likelihood of market weakness, so that when it does happen, it's not something that you case in point, weren't anticipating, and instead use that market weakness as an opportunity to build bullish positioning in your portfolios. For hedge funds who can be short, the main takeaway here is that during those moments of market weakness, unless the conditions inflect negatively, you're going to want to resist piling in on the short side. In fact, going forward, because we're in a rising tide lifts all boats type of an environment, most of your short exposure should actually be focused on stocks and sectors that are likely to simply go up less than the rest of the market. So staples, utilities, things like that don't typically do well during a rising market environment. They go up, they just go up a lot less. And so, but the main thing is during moments of market weakness, you're going to want to resist the temptation, and it will be there. You're going to want to resist the temptation of loading up your short book on cyclical names that are experiencing weakness, because that is, in a bull market, especially in the early stages of a new bull market, that is the worst time to load up on shorts in cyclical exposure. So going forward for the rest of this month, I would think that former resistance in that 42 to 4,300 area, which pretty much held sway over the market for almost a year, or at least a year, until we finally broke above it last month. That should now act as support to any market weakness. I'm not quite sure we'll get all the way down there, because that would be a bit more of a stretch of weakness that I would anticipate at this point, at least not until we get into resistance. So resistance is 45 to 4,700. I would think that we would get a bit deeper into that area before we do have any kind of a 5% or so pullback on the market. But nonetheless, the point is to not really have too concrete of an expectation as to when and where weakness will happen, just expect that it will, because this is just the nature of bull markets. We have plenty of sell-offs during bull markets, and the main thing is to expect them, anticipate them, and as long as they don't violate trend and the overall structure of the market remains healthy, be willing to ride through them and make adjustments to your portfolio to make sure that you're just keeping pace with the rotations in leadership, which will of course be all over in our weekly motor reports and charting my interruption, these videos and other things as well. Okay, so that's what we have for you in the month of July. Just a reminder that yes, of course, the market is overbought, but it has to be. It's breaking out. You cannot break out of a range without being as overbought as you've ever been since the range began. By definition, that is the definition of a breakout. So when you're hearing everybody talking about how overbought and the market is right now, just remember that it has to be overbought. And in fact, at this point in time, remember, the more overbought, the better. That's what you want to see in the early stages of a breakout. Leadership as it stands remains undeniably pro-cyclical, and it's only getting more so. After pausing for several months, energy is once again starting to take on characteristics of leadership, as well as it's bubbling up the performance ranks. Also, mid caps are beginning to make a comeback as well, which again, I think is just another indication of the market broadening out in a healthy fashion, and very much addressing that bearish divergence that everybody's been talking about, or at least labeling it as bearish. We've been not labeling it bearish. In fact, we've been of the mind that it was ultimately going to resolve bullishly, and we are once again finally beginning to see evidence that is coming to fruition. The motor management index is still fine. We're not really seeing any indications of any breakdown there from a trend perspective, but it is beginning to lose momentum relative to mid caps, which again is healthy. This is what we want to see as the market begins to broaden out, more reflective of what the market anticipates to be lasting leadership as the bull market begins to get underway towards the end of 2023 and into 2024. Okay, so thank you so much for listening this month. Again, once again, welcome to our new clients. Hope you enjoyed your first video. You, of course, have access to all of the archives to check out the old videos as well. If you have any questions, please feel free to reach out to me at any time. My email is here, D. Lundgren at MOTR, and Rick Casella, the Director of Business Development, is here as well. Please reach out to us if we can help in any way, and we'll see you next month.